The empty office building you drive past on your way home, somebody's bank is holding a loan on that. And it might be the bank where you hold your money. And that could be a serious problem because $875 billion worth of these loans are coming due this year. Most were written when interest rates were 3%. If they refinance today, they're looking at 6 or 7%. That math doesn't work. The borrower can't pay double the interest. If the borrower and the lender don't work something out quickly, someone is taking a huge loss. And you don't want to be collateral damage because your bank bit off more than they could chew. Because here's the deal, 59 of the 158 largest banks in America are sitting on more than 3 times their entire capital cushion in these loans. And here's the thing, you did everything right. You picked an FDIC insured bank. You read the sticker in the window. You watched Silicon Valley Bank collapse in 2023 and thought, thank God I'm not in tech. But the SVB problem was never tech. It was concentration. Too much money pointed in one direction. And in 2026, every regional bank in America is pointed at the same direction, toward that office building you keep driving past every day. And look, I know commercial real estate debt maturities sounds like the title of a pamphlet they hand you in hell's waiting room. But you don't want to turn away because the bank holding your checking account might be sitting on a financial nuke. So here's what I'm going to run through as fast as I can without leaving anything out that's meaningful to you. First, the $875 billion calendar about to roll through every regional bank in this country this year. Second, the names of 6 banks already publicly identified as the most exposed. Yours might be one of them. And third, the one move the Fed made last quarter that nobody else is connecting to this wave. So pull your most recent bank statement out of the drawer. We're going to look at what's actually sitting under your money. Item number 1, the maturity wall. So here's the calendar. The Mortgage Bankers Association. These are the people who literally track every commercial mortgage in America. They released a report on February 9th of this year. The number, $875 billion in commercial real estate debt that's scheduled to mature in 2026. That's a number so large, it sounds like the settlement a pharmaceutical company pays after accidentally turning a Midwestern town into radioactive zombies. And there's another $652 billion stepping up right behind it in 2027. Here's why this is important. When a commercial mortgage matures, 3 things can happen. The borrower refinances, or he sells the building, or he hands the bank the keys. So here's the math problem. Most of these loans were written between 2018 and 2021, when commercial mortgage rates were between 3 and 4%. The same loan today refinances between 6 and 7. So picture a $10 million loan written at 3% in 2019. The borrower paid $300,000 a year in interest. Today, that same loan refinances to $650,000 a year. His tenant rents didn't double. His expenses didn't fall. The math just changed underneath him. And he didn't fail. He didn't miss a payment for 7 years. The clock just ran out on the version of the math that did work. So does he hand the keys to the bank? Well, if so, the bank just inherited a building it doesn't want, marked at $10 million on the books, worth $7 million in today's market. Now multiply that across hundreds of loans on a single bank's books, and suddenly your friendly neighborhood bank is functionally insolvent. Item number 2, the named list. So who's holding these loans? Well, Dr. Rebel Cole runs something called the Banking Initiative at Florida Atlantic University. Every quarter, he pulls the public call report data from the FFIEC. That's the Federal Financial Institutions Examination Council, the regulator's own database. And he calculates one ratio for every bank in America. Total commercial real estate loans divided by total equity capital. If it's above 300%, the Federal Reserve itself flags it as excessive exposure. If it's above 500%, you're betting more than 5 times your entire safety cushion on commercial buildings holding their value this year. In Q3 of 25, Cole's screener identified 59 banks above the 300% line. Out of the 158 largest banks in America, 1 in 3. Now, of those 59, 6 stand out because they're the biggest, all over $50 billion in assets. Banks with branches in your neighborhood. Names you'd recognize: Flagstar Bank, Zion Bank Corp, Valley National Bank, Synovus Bank, Umpqua Bank, Old National Bank. all publicly identified as the most exposed regional banks in America. If you know someone with an account at any of these, send them this video. Their bank's not gonna. Flagstar specifically reported $51 billion in commercial real estate loans against just $9.3 billion in equity capital. That's a 553% concentration ratio. Having that percentage of your bank's exposure pointed at half-empty office buildings and desolate strip malls is like having 553% of your diet in gas station sushi. It's not a matter of if you're going to violently explode. It's just a question of what color the walls will be when you do. And look, these are real banks, branches in your neighborhood, statements arriving every month, the kind of bank where the teller gives your dog a treat, the kind of bank that hands you a calendar at the holidays. Item number 3, Metropolitan Capital, the cautionary tale. You want to know what this looks like when it actually plays out? On January 30th, 2026, Friday afternoon, this year, Chicago, a bank called Metropolitan Capital Bank and Trust, $261 million in assets, customers in 46 states and 10 countries, an office on East Ontario Street in the River North neighborhood, gets walked through the door by the Illinois Department of Financial and Professional Regulation. By Monday morning, the entire bank belongs to First Independence Bank in Detroit. First U.S. bank failure of 2026. Cost to the FDIC's deposit insurance fund, $19.7 million. The state regulator's words, unsafe and unsound conditions and an impaired capital position. Here's the part that matters. The CEO of Metropolitan Capital was a guy named Frank Novel, industry veteran, 3 banks before this one. And before that, he worked at the FDIC as bank examiner. In a twist so ironic it belongs in an Alanis Morissette song, the CEO of the first bank to fail in 2026 used to be the guy writing the regulatory red flag reports. That's like finding out the head of the fire marshal's office just burned down his own house trying to deep fry a frozen turkey. If the man who literally wrote the rules can't navigate this CRE environment, what makes you think the regional bank on your corner, staffed by people who've never seen anything like this before, what makes you think they're coming out the other side? By the third quarter of 2025, Metropolitan's deposits had dropped 10% in 9 months. The smart money was already walking out the door when they saw that before the regulators showed up. By the time you read about it on the news, the line had already moved. Deposit flight. This is how a bank failure actually starts. Not with a headline, with a quiet exit. Item number 4, the Bowman doctrine. And here's the part nobody is connecting. Federal Reserve Vice Chair for Supervision, Michelle Bowman, her job literally is to supervise the banks. All of them. Thousands of them. And in late 2025, she announced what's now being called the Bowman doctrine. It's a 30% reduction in the Fed's Division of Supervision and Regulation. Authorized headcount drops from approximately 500 to 350 by the end of 2026. That's 150 bank examiners gone. So we've got $875 billion in commercial real estate loans coming due this year. 59 of the 158 largest banks already over the regulatory red line. One bank already failed in January. And the Fed cuts its supervision staff by 30% in the exact same 12-month window. That is like watching a Category 5 hurricane approach the coast and deciding, you know what? This is the perfect time to fire the Coast Guard and replace them with a pamphlet on positive thinking. And look, I'm just a real estate guy, you know this. I buy houses for a living. I'm not a Federal Reserve insider, but even I can read a calendar and do 3rd grade math. But let's just say I couldn't. Well, the Federal Reserve's own supervisory principles document, November 2025, and the follow-up reporting from Reuters and the ABA Banking Journal confirmed the plan to cut supervision headcount by 30%. The Mortgage Bankers Association's February 9th, 2026 release confirms the maturity wall. Neither one is a leak. Neither one is anonymous. Both are official documents on official websites. Now, I can't prove this is intentional, but when the maturity wave is forecast publicly, the names of the at-risk banks are publicly published, and the Fed announces a supervision staff cut during the same 12-month window, at some point you stop calling that a coincidence. You start calling it a plan you weren't briefed on. The Fed didn't fail to see the wave coming. The Fed just fired the lifeguards before it hit. Item number 5, the hidden delinquency. And while we're connecting calendars, here's one more. TREP. They track commercial mortgage-backed securities. the bond market for commercial real estate. They released their January 2026 report. The office delinquency rate was 12.34%. TREP itself, in the same report, footnotes a category called performing matured balloon, which is Wall Street jargon for the loan blew up, but we're pretending it didn't. Across all commercial property types, the headline delinquency rate is 7.47%. Add the matured balloon loans back in, and the real number is 9.14%. That's 167 basis points hidden in a footnote. And that's the overall number. On office specifically, the property type sitting under most of the regional bank exposure, the headline already hit an all-time high of that 12.34% in January in their report. With the matured balloon adjustment, it's even higher than that. Banks have a phrase for this. They call it extend and pretend. You extend the loan past its maturity. You pretend it's still performing, and you don't record the loss on your books. The viewer sees a 7% delinquency rate. The reality is closer to 9. Multiply that across 158 banks holding hundreds of billions in CRE loans, and you understand why Dr. Cole's 59 bank list might be conservative. Because the official numbers are being managed. The banks that look fine on the headline rate might already be sitting on losses they haven't realized yet. This is the same pattern that played out in 2008. The bad mortgages were sitting on the books at origination value, while the actual market values had collapsed. The losses didn't show up until the loans matured and the banks were forced to mark them to market. By then, it was too late. The whole industry is just kicking a very expensive, very explosive can down the road. So the big question for 2026 is, when does the can stop rolling? And what does your bank look like when it does? All right, so let's get out of the indignation and into the action. You don't need an MBA to figure out where your bank stands. You need 10 minutes and maybe a phone. Move number 1. Find your bank's CRE concentration ratio. There's an easy way to do this. Go to the FAU Banking Initiative website. Dr. Cole already ranked every major U.S. bank by this exact number. Find yours on the list. Done. If your bank's not on Cole's list, and it might not be if it's too small of a bank, go to ffiec.gov. Pull your bank's most recent call report. Find the line that reads total commercial real estate loans divided by total risk-based capital. Either way, here's the verdict. If it's below 200%, you're green, you're good to go, go have a beer. 200 to 300%, that's yellow. Keep an eye on them over the next 2 quarterly reports. If it's above 300%, that's the regulatory red zone. Above 500%, that's trouble. That's Flagstar territory. So if your bank rings the alarm, here's the play. You don't close accounts, you don't cause a panic. You quietly start redirecting new deposits somewhere safer. Active defense, not panic. Move number 2. While you're at it, check your bank's deposit trend across the last 4 quarters. If deposits dropped 5% or more in that window, the smart money is already moving out the door. That's the Metropolitan Capital signature. That's what 10% deposit flight in 9 months looked like before the FDIC walked in on a Friday. If your bank is in the red zone and deposits are bleeding, that's not a yellow flag, that's a fire alarm. Time to act this week, not this quarter. And move number 3. If you've got cash above the $250,000 FDIC limit at any one bank, and that's exactly the SVB profile, by the way, splitting deposits across multiple lower risk banks is how you build a war chest that doesn't depend on which Friday night the next failure happens. I'll put a link in the description to a list of banks that I spread my cash across. Stackmybanks.com if you're listening on the podcast. That's the fortress move. So here's the choice. Option A, you do nothing. You assume FDIC insurance is the last word on safety. You trust the sticker in the window. You hope the bank examiners that do still have a job are watching your bank specifically. And you find out which side of the line your bank was on the same Friday afternoon the FDIC tells everyone else. Or option B, you spend 10 minutes this weekend on ffiec.gov. You pull the CRE concentration ratio for your bank. You make one informed decision about where your operating cash sits before the next failure announcement. Not after. The full list of 60 problem banks, that's hidden. That's kept from public view. But the CRE concentration data is not. One of those numbers tells you nothing. The other one tells you everything you need to know. Now let's say you do all that. You check your bank. The number's fine. Concentration, it's under 200%. Deposit trend is stable. You feel okay. Well, here's the part worth sitting with this weekend. Everything we just walked through is the part that hasn't been officially called a crisis yet. The maturity wall, the 59 banks over the line, the 150 examiners cut, the little footnote hiding the 167 basis points. None of that has a press conference attached to it. None of it is on the evening news. It's all sitting, though, in plain sight in government documents. But nobody's holding up a sign that says, "This is the failure." That's how these things always work. The signals show up before the announcement. The announcement comes after the people who were paying attention have already moved. So the question isn't whether the failure happens. The question is what you do before it gets called what it actually is. And that's exactly why I pulled this next video out here for you to watch next. You see, the bank is one system on the verge of failure. There are 6 others. 6 other places where the same kind of pressure is building. So even if your bank checks out clean tonight, and I hope it does, that's just one of 7. The other 6 don't care that you handled the first one. So watch this next. God loves you, and so do I. Take care.